Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel. It's the Tuesday edition of Building a Stock Portfolio. The only day we do the class, of course, but I am back with you all. My name is Kevin Horner. Pleased to be hosting today's Building a Stock Portfolio class, and I'm glad you're all joining. We're going to spend a few minutes doing a little market review at the close here today. Take a look at how the S&P, the NASDAQ, the Russell 2000 rounded out things, and then we're going to take a look at our example portfolio. We've managed over the last couple of weeks to maintain the majority of our positions thanks to some basic market movement, some ability to maintain with our stop levels. We'll talk about those levels. We'll raise some of those levels for those example positions. And then we're going to start a couple of new example positions today as well. So thanks to all of you for being here. We are joined by my friend and fellow Schwab coach, Connie Hill, in the chat. Connie, of course, a veteran of the markets, a veteran coach, certainly able to answer any of the questions that come our way there in chat today. She'll get to those that I'm unable to, but I will keep an eye on things as well, as I do want to hear from you as we work through the discussion. So please follow Connie and me on X if you're not already doing so. Connie Hill CS, Kevin Horner CS, a good spot to find us when we're not hosting classes for you here. So with that, we're going to get to our disclosure detail, and then we'll move in to the discussion. So first of all, remember that everything we discuss and cover for you today should be considered informational and educational only. We do not make recommendations. We do not endorse a specific approach to trading. However, we will incorporate technical analysis into our discussion, as is often the case. Remember that technical analysis is just one of those decision-making building blocks, though not the entirety of your decision-making process. So make sure you're balancing your decisions to buy and sell positions in the market with a multitude of factors, not exclusively technical analysis. Now, as I mentioned, we will do a little bit of a review of market activity. We'll build in and discuss technical analysis along the way. We're going to talk about the entry and management of our existing positions, and then look for some new ones to get started in as well. So let's start with how things finished the day today with the S&P 500. We had a nice day, a little better than 0.75%, recapturing our 20-day moving average there in orange. It's always nice when we can get back up above those important moving averages. The other thing that stands out on the SPX here is that we made that retreat into the vicinity of our gap level here from a few weeks back, or rather a few months back, as it goes back to the beginning of May already. But that level has been held, and so we did not make lower lows. Heck, we didn't even really make a matching low with that one, and now we're back above the 20-day. Now that doesn't mean necessarily it's comfort for all traders. Some of you are going to be happy to be back above the 20-day, and some of you are going to say, yeah, Kevin, I still see a downtrend line off the peak. So maybe we want to see a break through the downtrend line on a close. That would be kind of validating in nature, but it is notable that the RSI has followed price. So we've made a higher low with price, a higher low in RSI as well. And if we can stay above the 20-day for a series of, say, 3 to 5 consecutive closes, some traders, even if we don't take out the downtrend line immediately, some traders are going to be feeling better about that. Because if you go back to when we were last above the 20-day here, it only lasted 2 days, and then we got the big move, bounced back into the 20 and just couldn't hold it. So we've been choppy, really, for the month of June, and have not made higher highs, but have made lower highs. So the fact that we did not break down here is a real win initially. Let's hope that that's what is the prevailing action in the SPX, and that we take out the downtrend line coming tomorrow, as early as tomorrow. What we don't want to see, obviously, is a quick rejection and right back below the 20-day. So we'll monitor that, and we'll certainly talk about that in tomorrow morning's Trader Talk at Market Open. Now the NDX had a little bit of a better day, up about a little shy of 1 3/4%, but the chart looks very similar, doesn't it? Wonderful rally in terms of percentage today, higher lows in the most recent prices. We've maintained the 50-day quite nicely here, and then the gap level kind of comes back into this vicinity For horizontal, that would be kind of either matching lows or potentially lower lows, depending on how we handle it. But the fact that we've held that 50-day, cleanly with the lows of those 4 days prior to today, that's a really nice validation of the 50-period moving average there. I think a lot of traders are going to validate their trend now in the SPX and the NDX, perhaps with the 50 days. So back above the 20, nice development. Let's see if we can kick that further into the last ledge. You know, the biggest technical risk is that we've made that lower high, right? We want to make higher highs, not lower highs. So the fact that we rallied into that last peak and did not get to new highs stands out initially. So this gives us something that we would like to trade through, right? Let's just draw that line in horizontally, and then we've got something to talk about tomorrow morning. Hopefully it's hey, we gapped through 30,100 or 30,600, excuse me, and then just kept rallying. That's the kind of bullishness we would like to see. Of course, we don't always get what we'd like, but it's always helpful to give thought to what may play out. And if we get a break of the all-time highs, the expectation obviously would be continuation. Remember, new highs are not a bearish development, so that's what we're really looking for here. Good question here, Rita. Honestly, the question is, it relates, your question specifically, viewpoint on quarter end, positioning institutions. It's a big day, obviously. There's a lot of trading groups, large dollar pocket investors, hedge funds, mutual fund managers, etc. Sure. Last day of the quarter, last day of the month, that's not small development. This has been a choppy month in the first place, but I got to remind us that we've made a very strong move. And so while by and large we've gone sideways here since, say, April 8, so you're looking at about a 6 to 7 week sideways window. The main reason that's no big deal is because it rallied so wonderfully, right? I mean, we saw a 33% move in the NDX, a fantastic upside trend, and then we're going to need to consolidate. And really, if we just went to that peak, we basically have only spent June in sideways and consolidation, real choppiness here more than anything else. But I don't think it's terribly a negative, Rita. I don't think the view here of maybe what's gone on in the last, say, week to 2 weeks has been anything to destroy our trend. I think we could at least say that, right? Because what we've seen has been a nice move with the 50-day moving average catching up with all of this recent price acceleration, which is giving traders a little bit more confidence here. So we kind of like what we're seeing from the NDX even still. If we took a look at it on a weekly, it's just a good reminder that, hey, everything is stronger than maybe we have thought. The narratives, the negativity around the risk factors that are part of our markets. We lose one with oil dropping so dramatically. If that comes back to play in the market again, if we get ourselves back to strong momentum-based oil move, that could prove to be problematic. But yeah, we've seen a lot of those weakness concerns kind of fall by the wayside of late, and trend and price action has remained the leading most important factor, as it often does. Here we've got the Russell trading at highs, trading at all-time highs, holding 20-day moving averages. This has been a consistent move as well in the face of what we're expected to be higher rates. And even today, yields popping up 1%, and it didn't squash any move in the Russell 2000. So I think that's kind of notable because, again, the fact that the yields continue to stay elevated and there's concern about yields being raised, rates being kicked higher at the end of the year or between now and the end of the year, that's a concern for Russell. And yet, when you look at the Russell, it said that's fine with us because everything we've seen with the Russell has just been ongoing bullishness. Yeah, sure, we went sideways in there, tested this level, the breakout spot at around 2740. We've just continued to make higher lows along the way. So fall back into your basics, everybody. One higher low, another higher low, another higher low here, and we've held the 20-day. And so now maybe horizontal support comes into play. Let's duplicate that line and put that up close to the 20-day with another zone for potential support. So, a lot of the same stuff, everybody. The reminder needs to be that we can't forecast a breakdown in the market before it actually happens. If you find yourself putting yourself in bearish positions before the bearishness really hits, then we're in trouble. I mean, that's when we leave ourselves at pretty good risk for losses beyond our comfort, unfortunately. So, all right, there's your big three, everyone. Let's take some time and take a look at our current portfolio. I'm going to do that with my watch list. I'll close up the existing watch list. Let's open up the scratch pad so we can be reminded of our process a little bit. So we've had these positions for a while. Go back to our monitor page here. Let's check out how we're doing. Not too shabby, We've got some profitable positions, a couple that are a little bit tight, but we've maintained through here. Now, one of those trades did not do what I expected. That's the Keysight trade. I say that because, check this out, everybody. We had a drawback here, a pull down to below the 50-day, 20-day confluence, but it looks like, and then this is possible that this is wrong. Either A, the low of the day is not the real low of the day from yesterday, 327.04, but our low was our stop was in at 327.83. So I don't know why that did not fire. I expected that to go. We probably should have been stopped out, but it didn't fire. So we're going to leave our stop order on Keysight in there with the hope that it gets rallied into the highs. Maybe we have a chance to take some profits down the road. But, sometimes the trigger, and by the way, this really should have gone because it's a basic trigger and becomes a market order to sell. So if either A, it didn't trigger, or B, the system in paper money just ignored the fact that it triggered. I can't tell you which one. I just know that it probably should have triggered. So, but we'll keep it. We'll see what happens. We'll keep playing in this position and raise our stop along the way. We'll see if that happens going forward. Sometimes we just get lucky, I guess, but maybe that's the case here in Keysight. So stay the course there. Let's look at our Dell trade. The Dell trade, we just got started. I'm going to put my specific trades back in. We just added that a couple of weeks ago here, bought at 409.99. We built our exit strategy below the low here since it made its move. That low comes in right around 358. And so we've got to stop here down at, let's see, 326.72. Now we're back above the 20-day, so we have a couple of choices. We can go with the 20-day and an ATR beneath it to significantly raise our stop order. That would be fine. What I really want to make sure we do, no matter what, though, is that we want our stop below the low we made yesterday. Because what we don't want to see is a trade under yesterday's low. So if we went with the 20-day, which is now 409.49, so let me do a little bit of math here for us, 409.49, less our current average true range, ATR. We use one ATR in this class, 29.99. Let's just round that up to 30. What do you say? And that gives us 379.49. And our low here yesterday was 378.66. So we've done the math and learned that if we want the ATR, it's going to be 379.49, but we noticed that low yesterday was 378.66, less than $1 lower. We're going to go under yesterday's low still. So I'm going to take my stop. I'm going to go ahead and push it higher, but knowing that this is an amount that is less than the ATR, then or greater than the ATR, I'm perfectly fine with it. So this is incorporating both a little bit longer or wider of a stop order detail, right? And that's fine, but mainly because I want to make sure that if we trade below yesterday's low, that's the reasoning to be okay getting stopped out. I don't want to get stopped out on something that doesn't take us below yesterday's low, okay? So, because an open below, any action below yesterday's low could look pretty, not fantastic for bulls, right? We could easily get thrown even deeper. Maybe we start filling in the gap zone. So we don't want to play that way if we don't have to. So that's why. So that's what we're going to do on the Dell trade at least. Let's look at Dollar Tree. Dollar Tree's worked great so far because we bought in based on a move here. We had a break after earnings. So earnings come in and the stock gaps higher, breaks the downtrend line through here, and then not only gaps, but holds the price action over the 200-day moving average. That's what gave us the initial confidence to start that trade. So we built that trade in very quickly after the gap higher. And then we've just consolidated for 2 weeks and we made an exit strategy, our stop order built below the 200-day by the amount of the ATR. Well, now we have managed to get outside of all of that noise. So we had this little rectangle thing working, right? Kind of like so. And so we went from about 106.5 up to 117.5, so about a $10 to $11 move. Now we've got the stock potentially capable of getting us maybe another 10 points into the 127 plus. Now our initial exit is up here at those prior highs for the trade, so hopefully we get there, but we need to elevate our stop so that we reduce the risk of turning a winner into a loser. Now, we're going to go with the 20-day here once more because we're back above the 20, and we've also, as I zoom in here, everybody, just look at what's gone on since the gap move specifically. It allowed the 20-day to get caught up, right? We tested it right here, got a hold move right here, and have held it each day since. So that's why I think some traders are going to like the 20-day in this instance. So the 20-day is 113.65, and the ATR today 497. We'll go ahead and round that up to $5 even. That gives us 108.65. And you all know my preference in this case. We don't like nickels. We don't like zeros for those last digits on our stops. So let's go ahead and reduce the stop a little bit lower than 108.65. And we'll go with something like 108.57, 108.58, something like that. We're currently in at 100. So this is going to be a significant adjustment. I'll go ahead and cancel replace this portion of the order. And so again, we're going to kick that up 108. How about 57? There we go. And keeping it good till canceled for all 75 shares. And again, what I really like about this type of trade is that it is a risk-defined scenario. No, we can't guarantee that our stop, if triggered, is going to take us out at the trigger price. We know we have gap risk there, right? And it could trigger at 108.57, and we might be selling it at 105 or even 100 again. But at least we're trying, right? We're working to make this trade come out in our favor. We also have that target up above that we are striving to get to. So I will mention we have a trade coming up here you're going to like where we did take a little bit of profits and maintained a portion of it. We're going to talk about that one in just a minute here. But can even use the top of the range minus the ATR to increase profits. Yes. Now, of course, Rita, I can't guarantee, as you know, that that's going to increase your profits, but they will give you the chance to do so at least, right? So if you chose to tighten things up a little bit, one way might be the top of the former range, right? And use that level approximately, setting a price level, maybe even, the lows here are basically on the 20-day. So, there's a lot of ways to go about this, as you know, but ultimately, trying to be consistent with your process is the thing that I believe makes the most sense. So sometimes, a trader's going to work with that breakout level. Sometimes a trader's going to want that dynamic moving average like the 20-day. But one other alternative could be as simple as breaking it out. You've seen me do this before, guys. We'll do a layered exit. We've got 75 shares. Maybe you do 25 at an approximation of 1 ATR below the breakout, another 25 at an ATR below the 20-day, and then maybe another 25 an ATR below the 200, or on a close under the horizontal support level, and then you'd say, well, I shouldn't be holding anything if we took out the lows we've made since the move higher, and then a trader might just move on from the trade, right? So as always, you can step out of these positions. You don't need to be all in or all out. In fact, I think a lot of traders gain major benefit, mostly from an emotional stance, when layering their exit plan a little bit. So I can say that I support that concept. So there's the trade on Dollar Tree. We've made the adjustment there. We've done so on Dell. Let's look at EW, Edwards Lifesciences. Healthcare has been moving fantastically. We bought here, as you can see, way back at 78.61. We've actually been in this one a while, haven't we? This has been working wonderfully. So we got in here in mid-April. We've got a stop order on 50 shares that we have been adjusted as of a couple of weeks ago. And we also took some shares off. So what happened was we got 50 taken off at resistance at 87.01. So that worked out beautifully. Now we're sitting on 50 and we have rallied further. So we did that wonderful scenario, everybody, whereby we sold some at a possible resistance spot. We were right to have done so because it pulled back, and we were right to have kept some because we've traded those higher. So we've managed to do pretty well on this one. We do want to make an adjustment to try and work to lock in some of those profits. So we're going to look at the 20-day here. Look at how nice the 20-day is now with former resistance. Remember, former resistance can now be potential support, so we don't mind that confluence of data at all. So we're going to start there with 87.54, and our ATR is 242. We'll round up to 243, and that gives us 85.11. Currently, our 50 shares are at 83.46. So we probably just want to be somewhere in the neighborhood of in the 84.90s. So let's strive for that. I'll get it up into that zone. 84.91. That sounds good. Let's edit that. I don't like zeros. You all heard that. So we're going to go to one of my favorite years, 1994 it is. All right, 84.94 on the remaining 50 EW shares. Here we go. So we've elevated that stop. Again, we know that price is not a guarantee for us, of course. But given our entrance, if we were close to 84, we're going to walk away with a nice trade here if that plays out as we expect and hope. So good development there. All right, let's keep going. We've got two to play. Microchip. Microchip, we've done pretty all right on, everyone. We've got ourselves in a 25 share position. But notice our ledge, right? We've been working below the 50-day, and the 50-day has been great for us. So do we have a need to make an adjustment to this one? I think, I'd love to hear what you guys say about this. Tell me, you've got a stock that has 3 days below the confluence of the 20 and the 50. We came down and tested horizontal support and have bounced. But I think a lot of traders are looking at this and saying, yeah, this is not a place to make an adjustment to our stop. Because remember, we only raise our stop orders, everybody. We do not reduce our stops. So what we want to do is stick with this one. Let's see if we can't get this into a level well above the confluence of the 20 and the 50, and then that'll give us a much better opportunity to manage the risk. Because then once it's back up above the 20 and the 50 for, say, 3, 4, 5 sessions, if we can get them all in a row, even better, well, then we can use that number and come an ATR beneath it. So, all right, thank you, Beth. I'm glad you agree. Great yet. Thank you, Jim. That's what we're looking for. So some patience in the offing here. In fact, I think a lot of traders, if you saw that your stop order was set and you have, since you placed the trade, have had 2 levels get tested that didn't take you out, but held support above your stop, that probably gives you confidence that you've done a good job in building your strategy, building the exit plan. And that's what we're trying to do. We know that we're going to get stopped out from time to time, but in this case, the math on this, the approach of 1 ATR beneath our prevailing moving average has thus far worked out. So we'll keep the status quo on microchip. And then last, but certainly not least, is Morgan Stanley. Now, Morgan Stanley, we did that split trade here, everybody. So we bought our 40. We set an exit strategy to sell up there at 215. We sure enough got 215. So we sold 1/4 or 20%, 25% of our trade. And then we've got an exit here, stop order at 202.93. Now, this one's a little tricky, right? Because we are right at the 202.93 is our 50-day moving average, and our stop is at 202.27. Okay, so we're not great beneath the 50-day, are we? This one's at risk. Okay, and the reason it's at risk is because we are so close to the 50-day, and if we had a weak day, it's a weakness day, that is to say, yeah, it's possible that we could see well below 202.93. I mean, the ATR is $6. So if we just thought of it from that standpoint, say 203 less 6, that gives you, it means we could see 197 in theory, right? Now, the good news is, even if we saw 197 on a gap or something like that, we're going to be profitable. But in this case, I feel like it's more important to monitor the position, stay the course, and trade the plan that we've set for ourselves, which still works in this scenario. We built our exit against the 20. It is about a little less than $1 beneath the 50, the next level, but I'm hopeful that we don't actually get down there and actually get stopped out. If we get stopped out, we do, so be it, but the chances are in our favor that even if we get stopped out at the 50-day, everyone, we're going to be profitable. And we did a wonderfully, really good positive trade there, right? I know it was only 10 shares for $25, but that one worked out great. And if you're a trader who got in at 190 plus and decided to exit at 215 and you took all shares off, you're probably pretty pleased with yourself. You didn't forego a whole lot of upside. Maybe about 10 points of upside was all we would have missed if you took everything off with the bracket trade there. So we'll stay the course. Hopefully we see this one maintaining in the account next week when we revisit it. All right, so let's talk about a couple of new potential examples. And I went ahead and I went right back to the well, everybody. So back into technology. Now, admittedly, when I pulled this up today, financials are a little red. Financials have held up. It's not a terrible day for considering financials, simply because of the red, because we've consolidated after breaking higher. Notice the 20-day catching up. We might still need another few days here, where the 20-day gets caught up to this level, to the bottom of the flag that we're building here potentially. But admittedly, when I looked at the symbols that came in our all time frame watch list, remember we're looking for stocks that are trading above the 10, the 20, the 50, and the 200-day moving averages. It just didn't have nearly as much enthusiastic charting. I did find one, I'll point out, that may fit, and that was Prudential. So Prudential does look quite similar to the financial sector, right? And notice here we've cleared this gap and we've held, and it kind of looks like a bull flag as well, allowing the 20-day to get caught up in here. But it looked to me like it just maybe needs a little more time. So I went back to that technology. Tech up today, 2.5%. Looks like a well-established horizontal support. Now we'll just need to see. It's possible we get rejected here still, whether it's at the 20 or maybe even at those last highs. That shouldn't shock anyone if it happened, right? We should at least be prepared for such a rejection, even though we don't want to see it, of course. But again, look, we've made a good level here. We retreated to the midpoint of the RSI and held. So this does also look kind of interesting and relatively favorable, like a potential support has been established here. So possibly, an area of the market that's offering entrance at or near zones of support. So that's how tech made it to my table today. And I do have a couple of positions. So let us talk about Marvell. Marvell has an interesting chart. Marvell had a wonderful gap higher following earnings here. You'll notice the earnings period here on May 27, and it took a week, right? So it went, May 27 was right here. And then for 3 days, it was just like, oh, ho hum, nothing to see here. And then it just exploded. So we've got a pretty interesting level around 250 that has been established. And then another one at about 325, excuse me. So I had 75 on the brain because it's about a 75-point range. Now, if you're a bullish trader, one way to think about this is to give consideration to the recent lows at around 250 and start utilizing an ATR below that. Okay. And now you have to, in this instance, you've got to believe that what we're seeing in this chart is as bullish as it can be. And honestly, I think a lot of traders would point to the multiple tests in here. And this one, of course, from just yesterday with a huge hammer candle as validating the trend here, right? So with that in mind, I think it can make sense to consider an entry here. Now, the trader probably needs, because of where we are in the middle of this range, right? 250 to 325, and we're at around 297. So we're, 50 points from the bottom of support, 25 to resistance. It's a little bit inverted. But the trader here who thinks this is ready to break higher could be targeting a potential $100 move from this current price. The reason I say that, if we take the range, right, the height of our range is about 75 points, and the top of that range is 325 approximately. Add 75 to 325 and we find approximately 400. Now that's what we call a measured move. First and foremost, the stock hasn't done it, right? So we are, in this case, speculating a little bit. But in our speculation, it's really a speculation about risk versus reward initially, more so than speculative as it relates to support. I think a lot of traders would call out support quite in a bit more confidence here, right? And so even if they weren't convinced that this was ready to, pardon the expression, blow and go through 325 and immediately find it at 4, which I obviously not likely to happen. You're not likely to find a stock move that quickly to those levels, but certainly a possibility. The exuberance in this space of the market has been wonderful. And the fact that we've seen this one hold up exceptionally well after such a significant gap tells us something as well. So let's build a trade from here using the lows that we've established, and let's use the ATR of 27 points. So we're going to go from the ultimate low, which is 244, and we're going to reduce that by 27. And that gives us 217. And 217 is actually beneath the 50-day. So that's not terrible at all. Okay? That's going to give us some wiggle room. It might test our metal a little bit. So we are absolutely going to make sure that if we find ourselves getting stopped out, we're getting stopped out with a comfortable amount. So that means on Marvell, we have a $1,000 risk tolerance, as a reminder, everybody, for any trade we choose to take. So let's put in a limit to buy at 300 or less, and we'll use 300 and then about 215 for our stop order. And of course, you all know I'm going to go beneath it, but I'm going to use that for math. So that's 85 points of risk, which means we probably shouldn't have more than 10 shares, everyone. So that's a small trade to get us started. It feels like a lot of risk, but it's comfort within our tolerance for the trade, for the count, right? We don't want to lose 850, but we have an opportunity to do so. Let's just be smart by not making a trade for more than 10 shares. If this breaks out, then perhaps we can talk about an add later on, right? So if we can get this through 325 and start trending thereafter, maybe we can start talking about adding to the position, doubling from 10 shares. But let's go ahead and be smart about it. And instead of setting a sell target on this initially, we'll just go with a sell stop for our protection. So we'll, right click, buy custom with stop. We're going to do no more than 10 just to get us started. There we go. So we'll do 10 at a limit not to exceed 300. Again, that's a padded limit for tomorrow. And actually, yeah, let's just make that for, no. We're going to change it. We're going to go good till canceled. So if this happens to deviate a little tomorrow, let's say it opens over 300 and stays above it, but on Thursday it's back below 3, then we'll get ourselves our shares. So this way we get basically at least the next couple of days to see if we can get into it. And then after that, good till canceled, standard stop. I said 215, so let's go to 214 and 86 cents. All right. Good till canceled, 10 shares to buy. All right, so we're looking at no more than about 3,000 for the total purchase price. So we are well within our tolerance for position size. And while we can't guarantee it, we've given ourselves a pretty good wiggle room. The odds favor us, even if we get stopped out, losing less than 1,000, even though I can't guarantee that, of course. But let's go ahead and send that one off. All right, so there's your Marvell trade. And then one more example for us today in this position or in this tech space was on Zebra. And the reason Zebra came to my eye was because of the big continuation candle today through yesterday's high, again above the 200-day. So we've got day 2 above the 200-day. And then let's add some time to this chart, everybody. Let's go to 2 years. So what are we looking at? Well, we've seen some bouts above the 200, haven't we? So we can't assume that this is going to stay above the 200-day, but we've seen some improvement. Of all of those that I just showed you, this one's the only one with a close at highs. And that close today is the highest close we have seen since February. So you're looking at a 4+ month high close that is also higher than the 200-day moving average. And we've had no real time above the 200 since February of 25. So you're looking at about a 16-month window and about a 17-month downtrend. All right. So we might be breaking that. So if we're breaking it, then perhaps this is where a trader could get a position started and do so with a relatively low amount of risk. So let's zoom back in, take our 6-month view. Notice the prices action in here around the 50-day, everybody. I think the 50-day stands out as an area for trend management. So with that in mind, let us consider an entrance that gives us, and again, we can go as padded here as we want. We could actually go all the way up to 270 if we wanted, because when we say buy limit, just remember that buy limit is this price or less. So as long as the open is anything under the price we set, we can be a buyer. Or as long as it trades under at any point tomorrow or even Thursday under the level we set, we'll get into the trade. But more importantly, let's make sure that we use the ATR and our 50-day moving average. So our ATR is just shy of 11 and the 50-day is 238.62. So let's call it 227.62. And then if our entrance is, let's say, 260 27.62, just to make my math easy. We're going to be looking at 40 points of risk. So that means that 10 shares would be about $400. 20 shares would be about $800. Yep. And then 25 would be just shy of would be right at 1,000. All right. So we could do a full 25 share position, but I think given that we are a little wobbly, if you will, a little uncertain, let's just go with the 20. So we'll do a buy 20 Zebra as an example trade here with a stop at 227.62 and an entrance that is under 267. So right click, buy custom with stop. We'll make that a limit good till canceled at 267. So that's a pretty fair padded limit versus today's close. But again, it's helping us do the math on all of that, right? So we can be a buyer of 20, good till canceled at a price not to exceed 267, and then good till canceled on our exit at 227.62, and also good till canceled. Then a little confirm, buying 20 Zebra, 267 limit. Subsequently, if executed, our stop would be 227.62. All right, looks good. And there we go. So now we've got 2 new example trades to be looking to next week. Hopefully those will show up as part of our information technology group there. I did see, everybody, that we got a survey opportunity here in the chat. And of course, your feedback is very helpful to me. I always appreciate hearing from you, everyone. So if you've got the time, feel free to click that link. It'll open a browser window right next to this one, of course. And then you can take a moment to give a score. You can leave some notes if you'd like. Any comments, questions, etc., they come directly to me as the coach, the host of the class. So I always appreciate hearing from y'all. And remember, if you're catching this in the archive, you can also use the reply functionality beneath this window, and those come to us as well. So I'm happy to hear from you that way too. So with that, I'll also ask for a thumbs up on the screen beneath. Let me know what you thought about the class. Survey completion. Follow me and Connie on X. And don't forget, make sure you're subscribed to the channel, everybody. That'll do it for today. That's our wrap up. Our live classes on this fine Tuesday. And I'll be back with you tomorrow morning, Wednesday, for Market Open, and be joined by my friend Brent Moores, and we'll have a little chat on Trader Talk. So with that, have a great evening, everybody, and I look forward to catching up with you again real soon.